SEBI Chairperson Madhabi Puri Buch warned just yesterday, yet again, that she is surprised by the huge surge in derivative volumes. And she repeated the SEBI study, which showed that 90% of investors lose money in derivatives. Now, some bankers guess that the Reserve Bank may have made personal loans more expensive, at least partly to prevent bank money from going into equity derivatives. Now, one person who has done a comprehensive study on how derivative volumes have grown exponentially in India is Ashish Gupta, the CIO of Axis Mutual Fund. In his report, Gamification of Indian Equities, published last month, Gupta wrote that derivative volumes are 400x cash volumes in India. In other markets, it is 5 to 15 times. So, is something amiss here? Ashish Gupta, the CIO of Axis MF, the author of this report, is with us to explain. Ashish, good morning, and thank you very much indeed for joining us. Before I come to this report on gamification, which has made waves, let me just ask you about what Reserve Bank did, this making personal loans expensive. First, do you think there was some worry that it is going into equities? And secondly, what is its impact anyway, since you're a banking expert?
Sure. So I think certainly RBI move is very timely. While we don't have the data to indicate that this has happened because there was money moving from personal loans into the derivative market. Notwithstanding that, the growth in personal loans had been happening at a fast clip for a consistent period of time, well ahead of nominal GDP. If you see even recent data, the growth was to the tune of 30%. And as a prudent regulator, you have to move counter-cyclically in terms of your policies. So even as the banks are, or even NBFCs are not seeing major slippage in this segment yet, but as a regulator, I think it was prudent that they raised the risk weight at this point of time and really send a signal to the financial community that you have to be cautious in this segment.
Okay. Actually, for the third day running, Bajaj Finance, SBI cards are all, Chola investments are all in the red, third day in a row after the announcement. What's your takeaway from it? Does it make life difficult for NBFCs? And do you think there will be a reduction in consumer loans?
So I think certainly the central bank intends that there is some cooling off that takes place in this segment. While we still need to see what is the magnitude of interest rate increase that happens in these loans, and frankly, even though demand for these loans may not be very dependent and may not come down, even if rates go up by, say, 100, 125 basis points. But the fact is supply will come down. I think both banks and NBFCs will take the heat of the RBI move and pull back lending in the segment.
Okay. I'll, time permitting, come back to this theme. But now to go to that big report of yours on gamification of equities. The SEBI chairman is also warning that people are losing money, though SEBI sources told us that the financial system is not in danger. Would you agree with that? That we collect enough margins from the sellers, the option buyers are anyway paying upfront and losing it, so the system is out of danger.
So I think at this point of time, there is nothing to indicate that the system is really at any risk, or this growth in the derivative market is kind of driving the cash market. If you see, most of the volumes that actually happen in the index options. And if you see the cash market index constituents, they have actually, in fact, in most cases, underperformed the broader market, right? So I don't think it is the case that the derivative markets are pulling up the cash market valuation as yet. However, and I think this kind of dovetails into what you just mentioned about RBI moving ahead of the risk actually manifesting itself, right?
Okay.
So I think we need to be cautious that is the derivative market outsized compared to the cash market, and by most indicators that certainly looks like it, right? Because the option market in notional terms is over 400 times the cash market. Even if you look on a premium basis, now premium on options is about 70% of cash market volumes. If you look at global markets, this number is 2 to 3%. So whichever measure you look at it, the derivatives market is outsizing the cash market. And that's, I think, not a healthy way of developing the market. Frankly, derivatives themselves have little economic value, but as a hedge for the cash market, right? And therefore, the disconnect between the growth of the two is really quite perplexing.
Okay. But, I have two doubts on this. Let me first start with this volume itself. We had seen this even in China. I don't know whether it's one-to-one comparable, but there were a lot of articles probably 10 years ago that everybody in China is playing the equity market in one segment of the shares. But that didn't result in any financial destruction over there or calamity.
Sure.
And even when NSE first began in 95, there was a lot of chatter that, this is like a casino kind of game that's going on. But we never had any financial calamity. So is it calamitous?
Sure. So I think even if we rule that out, right, I think if we just go by the fact that there is no market disruption that is going to happen. But even then, what is the derivative market doing, right? So about 4 million people are trading in it. And as you mentioned earlier, 90% are losing money in it. If you see average age of the traders in this market is 29 years compared to, let's say in mutual fund industry, the average age of a mutual fund investor is about 40 years. And so what is the experience of capital markets, new entrants to the capital markets are getting, right? So I think that itself is a risk that the new generation experience in the capital market is starting off with a bad experience, and you don't want to really scar their psyche. Right. The second is what risk it potentially poses for the larger market. I think while it's true, I think regulators have moved aggressively, raised margins, and option writers have to post double-digit margins. A large share of those margins is actually through stocks as well. Right. So in case there is some fat tail events, in case there is a large moves in the market either ways, there can be potentially a follow-on impacts on the cash market.
Okay. That was going to be my second question. I told you the second doubt I had, what if there is a fat tail event? I mean, it can be anything, something like this SVB banking event in the US, a major institution caught in the wrong end or collapsing, or even in India, election results which are way out of whack, one way or the other, and therefore the market moves 10% either ways. Then are we in danger of option writers, collapsing the market?
Yeah. So I think clearly those are the risks that you need to watch out for. Again, we don't have enough data on the market-wide levels. We have some sense from some of the retail brokers that about 30% of the retail traders are actually writing options as well. But the other disconcerting fact about this derivative market is the tenure of investment is getting shorter and shorter, right? And that is what I've mentioned in my report as well. that the growth of the option market has actually really been triggered as tenor of the options went from monthly to weekly, and now most of it is on daily expiry basis, right? And even within that, what we are seeing, the average holding period of a contract by a retail trader is barely 30 minutes, right? So I really don't see what is the economic value of this sort of derivative trading that is being generated.
Okay. No, that's a fair point that you point out. Why encourage a game for its own sake? Ashish, I have just time for one more question, so I want to come back to the Reserve Bank moves and use your expertise in banking. How would you approach, I mean, in your new avatar, you would be buying NBFC debentures or bonds. How do you see the bond markets moving? Do you think there are going to be higher yields for NBFCs? Just the impact on NBFCs.
No, definitely. I think, and we have already started seeing some of that. So some of the spreads on NBFC papers have widened. The fact is not just RBI put higher risk weight on unsecured loans, it put higher risk weight on bank lending to NBFCs as well. So certainly both the bank borrowing costs for NBFCs will go up as well as the bond market costs for NBFCs. Having said that, I think most of the NBFCs are in a position where they have relatively low levels of leverage. Most of them, even with the risk weight increase on unsecured loans, will not need to raise additional capital. The demand outlook continues to be strong. Of course, they will need to temper down some of the growth in the unsecured segment because that's clearly the central bank direction.
Okay. All right. We'll wait to see how it plays out on the banking system and if there is any asset quality problem, even with NBFCs, and invite you for another day. Pleasure speaking with you, and it was a great pleasure reading your report. I must tell you that it's made waves in high places. Thank you very much, Ashish. And with that, we wrap up On Bazaar. Chartbusters up next.
पिछले 6 सालों से हर रोज यही हो रहा है।